One of the reasons that I love real estate is that it's an excellent way out for a lot of people. Everyone that's listening to this program, there was likely a time that you realized that the way you were thinking about money, investing, retirement, financial freedom was way off target from reality. Most importantly, if you listened to the mantras that you were taught in school, or weren't even taught in school, you'd probably never be able to retire, much less live out your glory years in a state that most people refer to as being financially free, right? The mindset that goes along with knowing that your cash flow is going to pay off all of your expenses to come. Well, this certainly happened for our guest today. Thankfully, he quickly learned the strategies and found the mentors that helped him get out of the rat race and go on to purchase more than 1,400 units, all in one market, pretty quickly. In this episode today, we're going to discuss our guest's last straw moment when he realized that he had to make a change, what really inspired that, how he was able to attract mentors that could help him, how he was able to identify them and then inspire them, why he exclusively focuses on San Antonio as opposed to being diversified across a lot of geographic locations, and how he focuses on business growth and simultaneously achieves more free time and more family time. Now, if you're not signed up for the Cashflow Connections mailing list, make sure to do so. I'm telling you, if you like real estate, and I know you do because you listen to the show, and you want to buy real estate, one of the skills that you're going to need is raising money. And something awesome is coming down the pike right now. I am very, very excited to launch my new book, Raising Capital for Real Estate, How to Attract Investors, Establish Credibility, and Fund Deals. But perhaps what I'm even more excited about is to share with you this little pre-sale goodie that I've created. So if you purchase the book prior to the launch date, you will instantly get access to closing strategies for high net worth investors. This is a video presentation that I did, and there are so many good takeaways in there. Like as I was doing it, I was like, man, this took me thousands of dollars and thousands of hours to learn. You're really going to like it, but it's only going out to the people who are on the Cashflow Connections mailing list. So go to cashflowconnections.com. Once the pre-sale is available, you'll receive a link to purchase it. And once you purchase it, you get instant access to closing strategies for high net worth investors. Then, of course, once the book is launched, you receive one straight to your doorstep. All right, hope you enjoy the episode. How's it going, everyone? Our guest for today is Devin Elder, who is the principal of DJE Texas Management Group, which is a multifamily investment firm based in San Antonio, Texas, which owns more than 1,400 multifamily units. We're going to talk about a lot of stuff today. We're going to talk about real estate. We're going to talk about building a team, building a network, and we're going to talk about some of the key takeaways from a coaching program that I know both I and our guest are big fans of. But before we jump into that, Devin, thanks for coming on the program.
Hunter, my pleasure. Thank you for having me.
So I want to hear more about your backstory. Before jumping into real estate, how did you get into this sector and what was your motivating factor for, leaving the corporate world or whatever your background is to really focusing on real estate as a whole?
Yeah, I did spend a number of years in the corporate world, a few of the largest employers here in San Antonio. I spent some time at each of them. I think I was late to the corporate world. I kind of did my own thing, and I've been a musician my whole life, and I spent a few years being a musician and finally decided, okay, it's time to get a corporate job. And I was very motivated for a few years. I think I'm kind of an obsessive person by nature, in that when I get interested in something, I get extremely interested and I spend all my time and energy on it. So that was kind of the corporate world for me for a little bit. I said, hey, I'm really going to give this my all. And it took a few years, but I started to just get jaded with kind of this concept where you get a promotion and you get a little bit more money, but you get a lot more time constraint. And that didn't seem like a scalable system to me, where I was getting incremental promotions and raises, but an inordinate amount of responsibility and stress. And then I had a lot of anti-heroes in the corporate world where there wasn't anybody that was 10 years older than me that I could point to and say, I really want to be like that guy. Mm-hmm. But there was a dozen guys that I could point to. And I said to myself, well, I'm never going to be that guy. And so I really had a lack of role models in the corporate world. And so after a number of years, I started to look for alternatives. And I think the foundation of that for me was just freedom. I mean, the money's one thing. It's a means to an end. But ultimately, I wanted to be able to create the lifestyle that I was imagining for myself. And then, of course, my family came along. And I was very inspired, like a lot of other people, by a book called Rich Dad, Poor Dad. And while that's a light on specifics, it's pretty heavy on inspiration. And so that's what kind of kicked it off for me was reading that book. And it took a few years from then until actually buying my first little single family rental. But that was really the genesis of just craving more freedom.
Well, I hear you on that. I think that the trap that is so common is in the corporate world particularly is, look, if you work 20% harder, we'll give you 15% more money.
Yes.
And it's like, wow, 15% more money. It's like, well, wait. What was the first part again? Like, that's the whole point, is that you could have been doing that all along. And that doesn't even factor in the fact that inflation's probably ticking along at 3 to 6%, depending on which metrics you're paying attention to.
Yep.
So it can certainly have that factor. I had an interview with Annie Duke who talked about things on a probabilistic basis and how the people's inability to see that when things shake up, they typically end up in a better place. So it's usually how frequently can you make those shake up moments happen? You start to see success more and more quickly. So definitely relate to that. Was there any last straw moment? I really like the fact that you mentioned that you didn't see anyone that was 10 years older than you that wanted to be like. That's a big red flag. Was there anything in particular that you remember happening that you said, okay, look, I have to make this shift. I have to jump out of this job that's reliable and do something more entrepreneurial?
Yeah, absolutely. There was a very clear defining moment, which was a very painful moment. And in retrospect, sounds very cliche, but it was one of the greatest things that ever happened to me. I had taken a position at what I would call a relatively small company for an industry that I was already familiar in, and said, hey, I'm going to take this risk on this small company with a little bit better title and see if I can make it work. And I really, really gave my heart and soul to that operation for a good amount of time. At this time, I had bought my first little single family rental. So I'd kind of gotten over that hump of going from what I would call going from 0 to 1, right? Everybody wants to be a real estate investor. Few are. And so I think when you cross over that threshold of 0 real estate investments to 1, a lot can change. So I'd already done this little house. And then I was working for this company where, it's hard to be objective about your own abilities, but in this instance, I was absolutely delivering a ton of value for this company. And then we had a management shakeup and my boss got laid off and I got laid off as part of that. And I just thought, wow, I've had jobs where I didn't give that my all and things turned out okay. And in this, I was absolutely giving my heart and soul. And this was the result that I get laid off. And so I made a promise to myself then and there that I would dust myself off, find the next corporate job, but that it would be my last corporate job that I was ever going to have in my lifetime. And so I think drawing the line in the sand was very powerful. I did find a job that was less stress, a little bit less pay, still a good paying 6-figure job, but less stress. And I worked my tail off for the next 2.5 years to build up a rental portfolio after hours and on the side while working that job. And it was really interesting. In that last job I had, my boss would say, what's your goal? What's your next plan? Who can I introduce you? The guy was really trying to help me kind of advance my career. And I wouldn't tell anybody about my real plan. I'd just say, hey, I'm here just plugging away, doing my job, which is completely counter to my nature, which is to always expand, always improve. And so it was almost like sitting on my hands and keeping my mouth shut at work. I would not go to lunch with people because all they do is complain about work. I would literally spend my lunches listening to podcasts and reading and going to properties and just completely immersing myself. So it was like, it's interesting. I hadn't thought about this in a few years, but I compare it to Shawshank Redemption, where, the last scene where he's crawling through, whatever it is, 2 miles of sewer to get out. And that was my 2 miles of sewer to crawl through was those last 2.5 years. And finally was able to do it, in 2015 and pull away. So, that's kind of what it looked like.
That's fascinating. And when you talk about giving your heart and soul to something, or just being obsessed with the things that you do, it is such an incredible, freeing and lucrative business to be in, the business that we're in, to give your heart and soul to real estate, to be obsessed with real estate. It is just such an excellent outlet for that obsession, right? Because the results can be quite profound. So to your point, you were able to transition out of that corporate position relatively quickly. And it didn't seem quick at the time, but looking back on it, I'm sure that you're pretty, happy with the way that you were able to accomplish that. Let's talk about some of the actual transactions that allowed you to accomplish that. You started in single family residential. Were you in single family the entirety of that transitional period, or did you start to expand into the multifamily sector?
I had dipped my toe in the multifamily world. So really the thing that allowed me to get started in real estate investing period was discovering this BRRRR model, right? That's kind of been made famous, which is buy, renovate, refinance, rent, and repeat. And I may have messed up the order there, but you get the gist of it. And that was, I could borrow money at double-digit interest rates from a hard money lender. I could borrow really 100% of the capital to buy and renovate. Then I could put a tenant in there, and then I could refinance out all my money. My goal was to have no more than $10,000 left in a project, and some of them I had $0 left. And that really set a light bulb off for me that, wow, I can start to establish and amass a portfolio with, I don't need $1 million to do this. I don't need all this cash so that was powerful. And I repeated that really into the point where I met my monthly budget requirement for the household was met by passive income. And that was the threshold that I had given myself to allow myself to quit the job. So I bought, it was like 20 something rentals with that method, which is just madness looking back on. I was meeting the title company at Starbucks to sign stuff and then go back to work. But I did buy a small multifamily on my own without partners during that time. And while I don't advocate people do that, I wouldn't do it again. It did get me in that multifamily world. And I wanted to do a deal with my own money before I started syndicating. And so I did dip my toe in the water there to the multifamily space before I quit the day job.
You mentioned that during lunch you would listen to podcasts, and I also deeply impacted by Rich Dad, Poor Dad. I hope that never stops coming up on these podcasts, because people that are listening at home, if you're younger and you haven't taken a look at that, that was a revolutionary book. And to your point, it wasn't specific in the sense that it wasn't a operating manual. It was basically like, this is a framework in which to view the world, particularly as it relates to finance. And it has been constantly coming up on the show ever since it's been launched, and for good reason. So you mentioned podcasts, you mentioned Rich Dad, Poor Dad. Did you ever have any specific personal mentors that played a role in your development as an investor, or did you figure it out all your own with the help of those other resources?
Yeah, that's such a great question. I absolutely had mentors. I ended up joining an investing club, and that was a huge turning point for me. And it's interesting because now, years later, I wouldn't really advocate that specific club to anybody, because it's one of those things where you learn more and go, oh, well, that maybe teaching some stuff that wasn't a good idea, and I've learned more and moved on. But I will credit them with giving me the belief. I mean, belief is such a powerful thing. And while there are tremendous educational resources out there, there's nothing like sitting across the table from somebody who is where you want to be, and they're nonchalant about their station. Yeah, we have this and that. And just seeing somebody that's, the light bulb goes off and go, well, this guy can do it, right? I can do it. And there's a very powerful transfer of belief that happens by surrounding yourself physically, personally, with people that are where you want to be. And that's the reason I'm in several high-level groups today, that cost a lot of money to be a part of, because the people in there, it's the adage that you don't want to be the smartest guy in the room. And so I attribute a lot of my success and speed to getting in the right room and just constantly willing to be a student. And so anyway, to answer your question, yeah, I joined a group, I paid some money and got in. And I think that shortcutted everything tremendously to be able to do that.
Yeah. And I had a similar experience with paid mentorship programs. So I moved to California, was really interested in real estate. The market was obviously very depressed in 2010 when I started studying the sector. And I was familiar with a couple of brands, some educational companies, and signed up for one. It was $5,000. And they basically had a coach who didn't have a lot of real estate experience, but would go through the manuals with me. But what they said was, go to meetup.com and look up some networking events in Los Angeles that suit your worldview when it comes to investing. And that was actually the beginning of my career. Now, whether or not the actual content in the manuals was good, or the person that was coaching me knew anything about real estate, that was really not a factor. But the fact that they just said, go to meetup.com and go to networking events, that's how my career actually started. So it's like, I can't say that $5,000 wasn't well worth it. It just wasn't spent the way that I thought it was going to be spent. And then we've also seen kind of a revolution in the paid coaching programs. I think, back then in particular, before the popularization of podcasts, there was so many $5,000, $10,000, $50,000, $100,000 coaching programs that were, again, taught by people that didn't have a lot of real estate experience. And from my perspective, at least, since those early times, there has been a massive switch, at least what I've been exposed to, where now there are $5, $10, $50, $25, $100,000 coaching programs that are led by absolutely gangbuster killers in the real estate and non-real estate sector. And it's something that I'm fascinated by, because when I used to hear that someone paid $25,000 to go to, let's say, quarterly networking events or something like that, I would say, okay, instantly, that's probably a fraud, if not worse, And now it's like, man, I've seen a lot of people gain a ton of contacts, information, theories, thoughts, and just being in those rooms sometimes could be really beneficial. Something I used to be very skeptical of, I'm now very much in line with, and I've actually seen some experience, not on that $25,000, $50,000, $100,000 level, but certainly paid for some mentorship that's helped me tremendously. So thanks for sharing that. So let's transition over to syndication. So obviously, let's talk about when you did end up creating your first syndication, what that deal looked like, and what happened the first time you went out to raise people's money for the first time.
Yeah, great question. So as I mentioned, I purchased a small multifamily myself, run every aspect of it, which taught me a lot about what I didn't want to do moving forward.
Right.
The next project was a 75 unit property. And the way I got into that was there was a couple that had done at least one other large multifamily, 100 plus unit. And they wanted a partner for this project. And I said, this is a great opportunity to work with somebody that has done it. And I don't have to have all of the responsibility, to get in there. And I advocate, I'm a big advocate of partnering to fill your gaps. And so it was kind of a comfort level thing for me. So partnered with them on a very, very heavy turnaround. I mean, it was a project we took down to one resident on 75 units and filled it back up. And it was incredible. And so the syndication piece, the operations was, I'll have stories about that till my deathbed, the kind of stuff we saw on that property. The syndication piece was actually relatively easy because as, large multifamily goes, it was like a couple $1 million to raise in equity. And I had some partners, so I wasn't doing all of it. And then really the thing that allowed me to feel comfortable moving into syndication is by the time I did my first syndication, I had actually raised millions of dollars and returned it and hit my pro forma numbers just on houses. And so I was borrowing private money. I would say, hey, I met a guy at a meetup and he said, looks like you got a little track record. This was early in my career. You're paying for hard money. How about I lend it to you at a little better rate and I'm a little easier to work with. And so, him and I still work together to this day. We've done millions of dollars of transactions and it started to build the muscle because I think, taking people's money should be terrifying, right? If you're starting out, and it should be the thing that you are most concerned about in your life, right? Because, a lot of syndicators will say this, but they actually treat investor capital to a higher standard than they treat their own capital. And I tend to do that. So that had got me a little bit building the muscle. Hey, borrowing money, $150K at a time for these houses, returning it in 6 months or 8 months with interest and kind of proving to myself, hey, I can be a good steward of people's capital. I can do these challenging projects and I can hit the returns that I'm promising. And so then when I went to go raise, $1 million, it was in my mind, it was like, well, I've really already kind of done this amount of money. It's just been not all in one project. And in some ways, doing it all in one project is actually easier. So it kind of built the muscle. And that was kind of my segue, at least from my perspective. I couldn't imagine going out, studying the business, and then going out and syndicating, multiple millions of dollars the first time out. I don't think I would have done it.
Yeah, it makes sense. And so let's talk about, how those original deals did, how do you still hold them to this day? Did you take them full cycle, or what those early deals, what was the end up result?
Yeah, both really, really good. But, in terms of net return, we can talk about all sort of construction deal, issues and rehabs and tenants and everything. But at the end of the day, there's one number. What's the net investor return, right? So whether it's an IRR or average annualized return, what's the net to investor compared to pro forma? It's kind of boil it down to one number. The first property that I bought on my own was great. I mean, it was just me, so there was no capital return, but that first little multifamily was, a 2.4x equity multiple. It made great return. Now, it wasn't a crazy huge dollar amount, but the return was there. The 75 unit was closer to a 20% IRR, which is a great return. We went full cycle on that relatively quickly. So it was, a deep value add deal where we did not project any distributions to investors. I mean, when you're taking it down to one tenant, you don't have a lot of cash flow, right?
Right.
So we basically scraped that thing down, filled it back up, and kind of immediately sold it. And I think that entire cycle was like 22 months. So pretty short.
Wow.
But, we hit a good solid, 20% IRR for investors. And I think more importantly, that was a tipping point for me to say, okay, I understand this now. I'm going to do some things differently than these partners that I'm with. I'm going to do a lot of things differently, but I'm in now. And now when I call this broker to go to lunch, they can't wait to go to lunch with me because they know I did that deal, right? And very quickly after that, it was actually during that deal, I bought another deal without partners that we're actually getting ready to go full cycle on right now. And by that point, I'd said, okay, I'm really kind of dialing in my systems, how I want to do things, the team I want to build. And it was really kind of starting to get legs. And I had this interesting parallel that I'd seen on the single family side, kind of a crawl, walk, run progression where there's a lot to learn at first. Everything seems overwhelming, but you get in, you do it, you learn, you iterate, you improve just like anything. And then after a couple of deals, it kind of becomes second nature. And so by my third multifamily deal, I was starting to feel like, okay, the pieces are really starting to make sense. I can see how I can start to automate and systematize some of this, how I can bring in, the right team members to do the right things, and started to kind of really get my confidence. At the same time, investor confidence was growing in me. So my ability to raise capital was growing, and broker confidence was growing because they could see that I'd done deals that, hey, this guy's bought some challenging deals, and now we're using his deal as the high comp in the submarket. And so, it kind of started to happen. And so what I'd seen happen with the single family business where, wow, we can really ramp this thing up, I started to see it happen in the multifamily business, which was the plan. And, you have plans, but it's really rewarding to see them actually start to flesh out and become real.
Let me ask you this. Let's transition into kind of the current state of the business. So those are kind of your earlier deals, definitely a lot of meat on the bone, so to speak, in terms of the work that you were doing. Now that you're up and running, give us a brief overview of kind of your current state of the real estate business, what your current typical purchases consist of in terms of underwriting, the markets that you find most advantageous, the property size, et cetera.
Yeah, so we're focusing exclusively in San Antonio for the time being. I get the question a lot of, are you looking at other markets? And frankly, we're seeing a lot of deals. Well, let me rephrase that. We're seeing a lot of projects hit our desk for underwriting. Not that they're deals. Most are not deals, but we're getting a look at a lot of assets. And in fact, really kind of at the max of our capacity with our underwriters and our team to be able to even look at all these things. So if that changes, we may look at other markets, but the story for now is, late 2019, San Antonio focus, 100 plus units, 1970 to 1990 construction. If it's in that range, I want to see it and underwrite it and tour it. Even if it doesn't pencil, the ask price is way too high. Listen, you never know. Things change, seller expectations change, deals fall out of contract. And there's really only 320 assets in San Antonio, period, that I would ever probably want to buy. So we want to get to, our firm goal is that we know everything we can about all of them. Who owns them, when they last traded hands, which one had fires. We want to know the entire landscape and go a mile deep on one market. So the 100 plus unit just weeds out a whole lot of properties. There's definitely opportunity there, but not with my model. My model is to bring in professional third-party property management company that those guys want the 100 plus unit. I want to have a payroll number on the property that I feel good about. I want full-time staff on the property and all these other kind of economies of scale components that you're just going to see on the larger deals. So that's what we're looking at. 100 plus units is putting our equity raises between, $2 and $8 million on a typical project.
Understood. and you're still seeing a lot of deals there in that San Antonio market. I happen to love that San Antonio market very much. We have a workforce housing fund that does not yet have an asset in San Antonio, but I would be very surprised if the fund closed without us having an asset there, because I'm a huge proponent of the market. I've seen a lot of the demographic shifts that I'm sure you're paying attention to as well, and the income growth and the job growth and the robust economy that's taking place in a lot of those submarkets. And it's really, really compelling. It's like a small city, but you still have all the benefits of that diversification of employment, et cetera. So I'm definitely bullish on that sector and in that market. Something that you've put a lot of energy, time towards is educating your investor base. I mean, obviously investors are going to be inclined to invest with you. You've been able to generate those types of returns, return their capital, execute the business plan, but sometimes courting new investors takes time. So walk us through, number one, why you made the decision to focus some of those efforts on educating your real estate base, and then also the mechanism by which you do create that content and help your business.
Sure. Yeah, that's a good point. I found with the equity raising for the syndications, it takes a lot of conversations, right? If you've got a $50,000 minimum on a $3 million equity raise, you do the math, and that's a lot of relationships that you need to have. We're doing 506B exemptions where we need to have a pre-existing relationship with investors. So the name of the game is to have those conversations. I think what spurred my content platform seemed to be the same 10 questions. I would meet with a friend of mine that was a dentist, and he'd invested in many of my projects over the years. And he'd have a buddy of his that was a dentist and say, hey, my buddy John is looking into this. He's works a lot, but has some capital, but he's not going to go out and operate these things. He wants to learn about passive investing. Okay, well, we're going to start with step one with John, and it's going to be the same 10 questions, right? And so I found myself answering those same 10 questions. I said, I know for certain I could put some of this in kind of a video FAQ library, and not that that's going to replace the conversation, but it happens constantly, and I'm sure it happens to you as well, where the first phone call you have with somebody, they've already basically feel like they know you because of the content that you create. And so That's been very powerful. If somebody's invested the time to watch my videos or listen to the podcast or whatever it is, before we even have that call, there's kind of this, we can shortcut a lot of stuff, which is beneficial for investors. They enjoy having kind of that free content source and a real look at how things operate. And then it's great for me because it's scalable. So that was really the impetus there, was to create my goal was that anybody's question, I could answer it. Hey, I'm going to answer it on the phone or at lunch. And then I'm going to send you a 5-minute video where I really break it down as a follow-up, and you can refer to that kind of again and again. And so the video FAQ morphed into a podcast and just creating a steady stream of content to be out there. And yeah, capital raising is an interesting thing. I mean, we hope that we're buying a lot of deals, but we're not going to push a deal on the underwriting just to buy one. And so we don't know, is it going to be 2 months till the next deal? Is it going to be 15 months? And so we're just kind of I'm always having the investor conversation and then trying to find deals that fit in there. But the content platform was really designed to address investor questions because I was seeing a lot of the same ones. And then in terms of creating it, I'm a big systems guy. I'm a big automations guy. And I like to create a system and create a very, very detailed publishing platform or checklist that somebody else can run. And so if I'm able to do that, I can just produce the content and kind of forget about the rest. And that allows me to focus where I should, which is on operating the business.
Certainly. And I really, obviously, I'm a huge fan of that lead nurture infrastructure. You mentioned the scalability of that infrastructure that you've created. I couldn't agree more. I was actually on a panel recently, and someone was asking me the difference between my online persona, which is readily available, and my actual personality. And he's like, what's actually going on behind the curtains? I'm like, well, actually, I hope you don't take this the wrong way, but there is no difference. That's right. The reason why it works so well is that I'm being myself. And if you listen to the show, you know me intimately well. And so it doesn't require my time to go through and build a relationship that would normally be created over years and years and years. You can spend hours and hours and hours listening to me talk on the program, and you get to know tons of my thoughts on a variety of different topics so that by the time we do get to talk on the phone, it's basically just to confirm that I'm actually a real person. And then once that's done, the level of trust there is so high because we've added so much content and educated and changed the way people think about a lot of different topics that it really helps the system. And by the way, educates the network of investors, which is absolutely critical, especially right now in terms of where we are in the cycle. So, if you're thinking about raising money, I am a huge proponent of building up that infrastructure. And by the way, even going about the process of building up that infrastructure itself will be so beneficial that you will see your ability to do whatever you're trying to do, whether it's operate the business or raise money. It will be better because if you're taking the time to go through and write it out or create that educational content, you think it through and become a true master in whatever that is. And that's kind of the definition of mastery there. So definitely think that that's worth your time, regardless if you even share it with anyone. So we're both benefactors of that.
Yeah, that's so true. I mean, I think there's the adage that when we teach, we learn twice, right? And so there is kind of a refining of your understanding. It's one thing to absorb information, and it's another to process it and put it back out. And I totally agree. It's kind of refined my thoughts on a whole host of components of the business, no doubt.
Do you do any coaching yourself or mentoring of kind of the next generation of real estate entrepreneurs or investors?
I've started to this last year with a handful of folks. We did a deal this year where actually an old friend from the corporate world, we've been friends for years and years and years, has kind of found his own way to real estate investing. And then eventually, when you are successful in single family, it's not too long before you realize, no, this doesn't scale very well. It's a lot of work.
Sure.
What's the next thing? And you kind of naturally gravitate towards multifamily. So he found his own way to multifamily investing. And then we reconnected, and there was a deal we did. We just closed it earlier this year. And I said, hey, why don't you come on to the management team? We'll give you some duties, and you can come on board, and it'll be a little test for me to see if I can, kind of teach you anything. And, I knew his character ahead of time. And that was kind of the number one thing. And he's a smart guy. And so that was enough for me to say, hey, come on. And one very interesting thing happened for me there. And I kind of use him as an example sometimes. I've been in the business long enough now where it's not exciting anymore. And, I love what I do every day, and I am passionate about it. But, it used to be that the thought of buying a $10 million building was like, oh my gosh, that's incredible. I don't have that anymore, right? That kind of awe is just gone. And now it's just kind of being an entrepreneur and getting the work done. But to work with people that have that awe, that inspires me. And to kind of see that light bulb go off for other people is like, wow, that's, my buddy said, I'm really fired up about this. And I said, well, I'm not. To me, it's just kind of numbers, and we're just going to execute. But the fact that you're excited about it, that's firing me up. So that was kind of an interesting unintended consequence of bringing him on as a partner and kind of having a coaching role. I haven't really formalized that out to kind of roll it out to a wider group. But, I have enjoyed that component of it, and it's an ecosystem, and eventually I'm going to want to transition to more of a passive role. I am now, but it's predominantly an active role, and I'm going to need good partners and operators to invest my capital with. So I think it is a continuum. I'm a link in a chain. There's so many people above me that have helped me, and hopefully there's people behind me that I'm helping through.
Understood. There was someone that was mentioned on a panel that you and I actually were on together, an online panel to talk about kind of creating that content, creating that online educational platform. And you mentioned the name of someone that at the time I didn't know very well, but had heard a little bit of. And that name now means a lot to me in my business. And that name is Dan Sullivan. And I wanted to give you the opportunity to share with the audience who that person is and how they impacted your life, either directly or indirectly.
Yeah. So Dan Sullivan's a very special person and a very special entrepreneur that I was introduced to many years ago. And I think this coincided with kind of this 2008 timeframe when I was reading Rich Dad, Poor Dad, which was before I got into real estate, but when I was starting to kind of get disillusioned with the corporate world and reading these books. I was fortunate enough that my older brother has been an entrepreneur since day one. The guy's never had a job. He's completely unemployable. He's had multiple companies and several exits and so forth. But he joined a program called Strategic Coach, which Dan Sullivan founded, I think, over 30 years ago. Dan Sullivan is not a flash in the pan. He's an institution, and Strategic Coach is an institution. So I was exposed to some of those materials really just kind of through my brother and having conversations. And at the time, they were just incredibly powerful entrepreneurial tools, which I really got just by osmosis. I mean, I wasn't in Strategic Coach. I was just kind of hearing my brother talk about it, and then seeing my brother's business at the time literally just hit this very obvious pivot point, which was kind of pre-Strategic Coach for him and post. And it, was like hockey stick in terms of the growth of the business and his kind of free time and happiness. And so that got my attention. And I've been a huge fan of Dan Sullivan ever since. This is, years and years, as a decade now of kind of following this Strategic Coach and the entrepreneurial tool sets that they have.
Yeah, I think it's pretty fascinating how frequently you hear the combination of those two things in the Strategic Coach world, and you never hear them outside of the Strategic Coach world, which, if you're listening, you may have caught it, which is the hockey stick-like growth complemented by the free time. That is something that's very, very hard to achieve simultaneously.
Right.
I mean, going back to the beginning of this conversation, we're talking about, look, at a corporate world, hey, listen, if you work 20% harder, we'll give you this 15% raise. That's not a good deal. Well, in the entrepreneur world, really the question is, when can entrepreneurs work? All the time.
Right.
When do they need to be working? All the time. When can their work create some positive benefit for their financial situation? All the time. So you get in this situation where you left the corporate world to try to avoid that extra 20% for the 15%, and now you're in the 300% for the extra 10% thing as the entrepreneur.
Right.
Or the extra 300% for the who knows what, because it's unpredictable as an entrepreneur. But with Strategic Coach, really an important point of the whole structure is really thinking about your time as being incredibly important. And it's fascinating as we go through the program, and I'm actually in the signature program right now, and I'm about to renew for another year, seeing people simultaneously experience the complexities of their business increase, the lucrativeness of their business increase, the revenue streams increase, but also they're able to take free days. They're able to spend more time with their family. And it's because it's forced on them that it is a priority. And then you also get a litany of other tools, which are just invaluable. And this isn't really a pitch for Strategic Coach. I don't have a referral fee or anything like that. I'm a really big fan of entrepreneurship, and it is really a great insight into what it's like to be an entrepreneur and what it's really all about. So if you're interested, shoot me an email. I'll be happy to kind of refer you over to them. They're an excellent company over there. Let me ask you this before we jump off. We've obviously talked about a lot of exciting stuff. We talked about the San Antonio market. We talked about some awesome exits that you've been involved in. What, if anything, concerns you about the real estate space right now? There's been a lot of changes over the last 10 years and since you've been in the business. Is there anything that you're seeing that you're skeptical of or concerned with, whether it's related to market valuations or something else?
Sure. There sure is. I have a larger kind of macroeconomic fear about what happens when you print trillions of dollars for an extended period of time. If I just got a new credit card every month to put my car and mortgage on, it's not sustainable, right? We understand that at the micro level. I'm very curious about the macro level. And I don't want to go too far off a tangent here. I was, for a period there, very concerned that the dollar's off the gold standard since the 70s, and the dollar's not tied to anything. I've since kind of come around to an acceptance that at the end of the day, the US dollar is effectively backed by lead, right? The US dollar is backed by the US military, which is far and away the most dominant military power ever in existence. That gives me a little bit of comfort. But printing all this money and all this quantitative easing for, this unprecedented period gives me a lot of concern, from a global financial perspective. On a smaller level for multifamily investing, the cap rates continuing to compress, and we think they're going to bounce. And in our underwriting, we account for expanding cap rates, and they just keep going lower and lower. And it's like, that's concerning to me, right? So that's we're very long in the cycle. A cycle's not going to die of old age. Something's going to happen. But obviously, if you just look at patterns, we're due for a correction and something's coming. But you've had people sitting on the sidelines in cash for 5 years now, too. So, I'm not of the mind to just sit on the sidelines for a decade. But cap rate compression is very interesting and concerning, because if they bump up, if a cap rate bumps up 2 points, you're just going to see this massive devastation of equity. And so that's probably the biggest concern. We're looking at deals getting to very micro level where there's some kind of obvious value add. We're not just buying a deal and taking it over. We want to go in, spend some money, and force appreciation through operations, through renovations and rent premiums, through a combination of things. So we need to be able to go in and create some value in year one. And so that gives us a little bit of cushion. I also really like our market. I think as long as there's a diverse labor providers and diverse jobs in the market, and a lot of people moving to a market, I feel good about that. If people started to flee San Antonio, I'd be very concerned about our holdings, but fortunately it's the opposite. So I like a lot of the things that are happening in San Antonio. I like some of the trends toward renting. I like the fact that we're buying an asset class B and C multifamily that is very supply constrained. And so your demand is high. But what's going on with cap rates here? It's always been kind of disconcerting to me that we can underwrite all these different formulas, and whether it's rent growth or rent premiums and returns on what we're going to spend to renovate the interior of a unit. But you play with the exit cap rate by 50 basis points and it moves the deal by millions of dollars. And so that's pretty much my number one concern right now is what's going to happen in the future with cap rates.
Certainly. That's obviously an interesting tie-in with the comments you made about the trillions of dollars of quantitative easing. And it's something that we've talked a little bit about on the show as well, which is kind of reconciling that reality that cap rates are continuing to decrease. It does tie in with that quantitative easing conversation because there's trillions of dollars floating around the global capital markets, which are looking for yield.
Right.
And real estate continues to be an incredibly advantageous asset class, particularly United States real estate. So I too share your sympathies about the challenges with cap rates. I mean, originally, this business, which is currently ASIM Capital, was previously titled Cash Flow Connections, and it was really focused explicitly on cash flow. And we had cash flow metrics that we simply wouldn't go below. And, I didn't understand at the time that market dynamics change and that straight up focusing on cash flow, buying only stabilized assets is only something that can be done in the wake of one of the most significant corrections in the history of the United States. Sure. And so then we started to transition our buying strategy to focus more on those value add deals where not only can you supercharge the return profile, but the other end of that spectrum is that when you add significant value, you're protecting your equity better. And so it's an interesting space to play in. Of course, the other argument is if you can add $100,000 of NOI to a property that's an 8 cap, well, if it's trading at a 5 cap, it's much more advantageous to add it to a 5 cap. And so we've seen a lot of those properties in 2008 that were trading at 8 caps, now trading at 5 caps. So right. It's an interesting conversation. Of course, I'm not a perma bull on anything, especially something related to investing, but it's an interesting kind of conversation that's been coming up a lot. 2 questions. One is, I know that you are super focused on education, always looking to learn. What's your favorite book that you've read over the last 12 months?
Probably a book. There's so many, but there's a book called Oversubscribed that I think, I'm going to get the author's name wrong, but I believe it's Daniel Priestley. Really great book. And the premise is that there's multiple kind of business concepts in there, but how do businesses get oversubscribed? Why are there a line for some businesses and other businesses are empty? And it really dives into some very specific tools that I think a lot of entrepreneurs would benefit from. And that was recommended to me by an entrepreneur that I hold in very high regard. Anytime he mentions a book, I immediately get on my phone and buy it. Okay. And that's one that I recommend, especially for people that are in the space of raising equity.
I love it. That sounds great. It's actually been mentioned to me before, but I'll definitely link to it because I am looking for a book right now, and I know that that's a good suggestion.
Yeah, it's a fun read too. It's not too dense, very practical and enjoyable. So I recommend it.
All right. Last question. This is an easy one. Please let the listeners know how to get in touch with you. And obviously, we've learned a lot today. We've covered a ton of topics, but I'm sure that there's going to be people that are interested in learning more about your business. So let the listeners know how they can do that.
Yeah, the best place is just to look for me and my company. My company is called DJE Texas Management Group, like Delta Juliet Echo. And if you just plug that into Google, you're going to see podcasts, website. We set up a pretty easy system where you can hit the website, sign up for kind of a free download. And then the very next thank you page is a link to my calendar. So, if somebody wants to have a 15-minute chat, There's been all kind of good things that come out of that, right? Whether it's helping other people or deals, or if I can point to somebody to a resource, that's a very easy way to do that. Just hit the website.
Easy to do. All right, Devin, really appreciate it, man. Thanks again. And I know we didn't talk a ton about the details of real estate, but I wanted to have you on to talk about some bigger picture stuff. Let's definitely do it in the future where we can talk about, specifics of the deals that you're working on.
Hunter, thanks so much for having me on. Really enjoyed it.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.